What's going on, my YouTube family? It is so good to see all of you and see your beautiful smiling faces across the internet. If you're joining us for the first time, my name is Mike the CPA, and here on Money in Life, we teach finances, investing, taxes, and more. Now, I know it's been a while since I've made a video around Roth IRAs. Well, I finally have another one for you, and in today's video, we're gonna cover the many different traps when it comes to Roth IRA penalties. Roth IRAs have great tax advantages. They can be great for your long-term retirement needs. However, there's many penalty traps people fall into, and I hope to help you avoid those today. Not only will I be covering the 10% penalty with you guys, but I'm going to mention a few other penalties as well that you might not be aware of. I have a spreadsheet I've designed for you to simplify this information as much as I possibly could. All of the information you're seeing came directly from the IRS publication, and that's how I've constructed the spreadsheet. You can find this spreadsheet free to download in the description, and I'll also put it in the comments section down below. I see a lot of people out there as a CPA make mistakes like this, so this whole video will really summarize the bulk of all Roth IRA penalties. With the spreadsheet, you're going to see I've designed it by age, the reason for distribution, whether or not it's a qualified distribution, which we're about to talk about right now, if the 10% tax penalty applies, if income tax will apply on your earnings when you take the distribution, and if income tax will not apply on the earnings when you take the distribution. Now, penalties for Roth IRAs are generally come into play when you actually do take money out of the account. That's when more or less you're going to be subject to one of these penalties, unless there's other special circumstances, which we're going to talk about later in the video. But let's start with a qualified distribution. What is that? So let's flip over here. I pulled this up on screen. This is from the IRS website. It says a qualified, if you don't know what this is, it says a qualified distribution from a designated Roth account is excludable, not included, from gross income. So it's not included in your gross income. A qualified distribution is one that occurs at least 5 years after the year of the employee's first designated Roth contribution, counting the first year as part of the 5. And it's made on or after the attainment of age 59 and a half on account of the employee's disability. So if you become disabled at any age, you can take the money out without penalties, or on or after the employee's death.
Ooh, I'll be looking forward to that day.
Yeah, thanks a lot, Chipper. Love you too. That bird's just waiting me out. So that's essentially what a qualified distribution is. If you want to learn what a non-qualified distribution is, you can pause the video and just read this right here. All right, let's run through some scenarios, because there's many different scenarios of when you either won't be penalized or you will be penalized with that 10% early withdrawal penalty. So the way that works is that, let's say you take out $1,000, you distribute from your Roth $1,000, right? So if it's not a qualified distribution, you're going to pay a 10% on the total amount of the distribution. So $1,000 in this example times 10% means you're paying an extra $100 in tax. And you're going to pay that tax when you go to file your tax return for the coming year. So starting with this first one, if you're under age 59 and a half, if you take out the contributions only from your Roth, then as far as I know of, as far as I understand, that's going to be a qualified distribution. Okay, so you're not touching the earnings, but only what you've put in yourself. Does the 10% penalty apply? No. And in this instance, if you're just withdrawing your contributions, you're not touching earnings, then there's no tax that you have to worry about. Now, if you convert an account from a traditional IRA to a Roth IRA, as far as I understand, as far as I know of, you have to keep that money that you've converted in that Roth for at least 5 years before you can start to pull it out without facing tax consequences or penalties. So if that's not the case, if you guys know differently, please let me know. Okay, let's look at the next scenario. A very common scenario we see is that people, they put money in one of these retirement accounts, such as a Roth, they get in trouble financially, or they have debt to pay, they lose their job, whatever, and so they need money because they're broke. So of course, they see their nice pile of cash sitting over here in their Roth IRA, so they go and touch it, right? because they figure if they lost their job, they're going to be okay to touch it without anything backfiring on them. Well, that's not always the case. So if you need cash just because you're broke, that is not considered a qualified distribution. So what that means is whatever amount you take out, it's going to be hit with a 10% tax penalty. And if you withdraw the earnings as well, you're also going to pay your income taxes on that as well. So you're going to have your 10% penalty plus whatever your income tax rate is on that for federal and state is going to be applied to you. Of course, if you had that money in the account for longer than 5 years, income tax may or may not apply on the distribution. It just depends. It could be partially taxed or fully taxed, depending upon your situation. So let's say for whatever reason you become disabled or you're currently disabled and you have money in one of these Roth IRA accounts. Well, if you take money out, it's okay. So it's known as a qualified distribution. No 10% penalty will apply to you, which is great. Tax may apply on the earnings if that money has been in your Roth for less than 5 years. So that may apply. But if your money, like most of these, if it's been in there longer than 5 years, then tax generally will not apply. So that's just the general rule of thumb. I'll make a separate video on taxes with Roths. There are situations with a Roth where you can pay tax. I'll make a separate video for that, but I'm just going to focus primarily on the penalties the rest of the video and not cover too much on the tax side. All right, so let's go down to the next one. Now, many of you heard there's exclusions for certain things you can take money out and not be penalized, and that is true. And buying your first home, if you need to distribute money to buy your first property or build or rebuild your first home, then you can withdraw currently up to $10,000 from your Roth IRA, and it's known as a qualified distribution. No penalties apply. So what if you did lose your job? Well, if you just lost your job and you need money, remember that is not a qualified distribution. But if you lose your job, now all of a sudden you don't have medical insurance, you need to pay for medical insurance. Well, you can withdraw from your Roth to help you afford medical insurance, and that's known as a qualified distribution, and you will not be penalized regardless of your age for doing that. The next situation is non-reimbursed medical expenses. Now, it doesn't count for all medical expenses. You have to look very closely. It says non-reimbursed medical expenses that exceed 10% of your adjusted gross income. So what does that mean? So if you think about your tax return for a second, and let's say your adjusted gross income is $50,000. Well, your medical expenses would need to exceed 10% of $50,000 before your Roth distributions would become qualified. So you would have to have medical expenses in that case, if you have an AGI of $50,000, greater than $5,000 medical expenses before you could withdraw from your Roth IRA without incurring an early withdrawal penalty. So that's how that works. So just be careful on that. A lot of people just say, oh yeah, you can take it out for medical expenses. Yes, but only those medical expenses that exceed 10% of your AGI for the year. Now this one, a lot of you guys are gonna like. So what about qualified higher education expenses? What if you need the money for school? And by qualified higher education expenses, generally what that means is you're pursuing a degree at a four-year university, a junior college, or whatever, or like a master's degree, things like that. If you're just trying to get a certification or license, it's not going to count towards that because they don't consider that qualified higher education. It's only in the pursuit of a degree at an accredited school or university. Now, it also applies to certain family members, which is great. So if you have kids, if you want to help them with their college, you can do that. So if you distribute from the Roth, no penalty is going to apply to you. So that's very cool. So if you're going to school and need some money, your Roth can help you there, even if you're under age 59 and a half. What if you die? Now Chipper, like I said earlier, Chipper, apparently he's just waiting for me to die so he can inherit this money. If you've made somebody the beneficiary to your estate after your death, well, once you've passed away and let's say you were the Roth account holder, your beneficiary can take that money out without penalty. Now there's special rules, but generally speaking, they can, if they're a designated beneficiary, which you would have assigned who your beneficiaries are, hopefully, when you were setting up your account. If you were to die, then that money will go directly to them. And it's either going to go to them, it has to be paid out to them in 5 equal payments, or it's going to be based on their life expectancy, depending upon how you set up the account, how old they are, and so on and so forth. But those distributions are generally qualified, okay? So normally, if you're a beneficiary of a Roth, you can take the money out, generally without penalties, even if you're under age 59 and a half. The next area where penalties don't apply is a qualified disaster recovery assistance distribution. Let's say you've just gone through a hurricane, a tornado, or some qualified disaster area. Well, then distributions are going to be qualified to come out of your account without penalties, even if you're under 59 and a half, because you've just gone through some catastrophic event in your life and the government is giving you a break on that. The next one is a qualified reservist distribution. Now, this is mainly for people who are in the military or who are on the reserve list, and at some point they might get called back to service. So if you're a member of the National Guard, for example, called to duty for at least 180 days, then that could be a qualified distribution if that's your scenario. And you can, even if you're under age 59 and a half, you can take out the money without penalties. Okay, the last two here on the 10% early withdrawal penalty. So you've reached age 59 and a half. So the day you become 59 and a half, doesn't matter why you take out the money from your Roth, it is now deemed a qualified distribution. You no longer have to worry about that 10% early withdrawal penalty. And at that point, life is good, ladies and gentlemen, life is good. The last one I have on this list before we dive into a couple of the other penalties real quick that are associated with Roths is prohibited transactions. So I've left a link to the publication that I've actually used to produce this spreadsheet in this video. But there are prohibited transactions, so especially if you have more so I think if you have a self-directed IRA, what you're in charge of, well, there's certain things you can't do. Like you can't use your Roth as collateral to get a loan. You can't sell property to your Roth. And there's certain prohibited transactions that could get you in a lot of trouble. So you really want to know what those are. Like you can't buy collectibles within your Roth, or there's rules around collectibles like gold and things like that, like physical gold. I'm not talking about stocks. I'm talking about like physical assets and things like that. So just know what they are, and you can explore that further in detail by clicking this link here and checking out the prohibited transaction portion of this publication. Okay, there's a few more penalties I want you to be aware of with Roths so that you have a full overview of what to expect. There is, now, generally speaking, there is no required minimum distribution penalty for a Roth IRA. There would be one for a traditional IRA, but not so much for a Roth. However, let's read this real quick just so you guys are aware. It says you aren't required, now this is from the publication as well, 590B from the IRS website. It says you aren't required to take distributions from your Roth at any age. The minimum distribution rules that apply to traditional IRAs don't apply to Roths while the owner is alive. That's a key point. It does not apply as long as you are alive, okay? However, after the death of a Roth IRA owner, certain minimum distribution rules that apply to traditional IRAs also will then apply to Roth IRAs, as explained later under distributions and after the owner's death. So basically, this is what you need to know. Generally, the entire interest in a Roth IRA must be distributed by the end of the 5th calendar year, which was what we talked about a little bit earlier in the video, after the year of the owner's death. So you must distribute that money within 5 years, if you're the beneficiary of that IRA, within 5 years of the owner's death, unless the interest is payable to a designated beneficiary over the life or life expectancy of the beneficiary. So not of the owner, not of the original owner of the Roth, but over the life expectancy of the beneficiary. And the Roth IRA holder will designate that, or the rules will come into play based upon the circumstances. So you always want to check if you are inheriting a Roth, make sure you're consulting with somebody to see how that's working. But generally speaking, you're going to get that money in 5 equal installments over 5 years. Okay, so that is the RMD penalty, okay? And so the RMD penalty is huge. It's huge. And so if your required minimum distribution, let's say it's $10,000. Well, I don't know if you guys know this, but the required minimum distribution penalty is generally 50% of the required minimum distribution.
Wow, damn, he's killed though.
That's right, 50 freaking percent. It's like paying tax at 50% rate, which is absolutely extortion in my opinion. So if you were required to withdraw $10,000 from that account, your penalty, and you didn't do it, your penalty would be $5,000 that would now all go to the government just because you didn't take the money out of the account in time. What a frickin' bummer. You thought there was just an early withdrawal penalty, right? No. There's several penalties involved with these Roths that you have to be aware of. What about penalties? This is a common one. Now, this one's pretty common, is that penalties for excess contributions, not distributions, but contributions. So basically what that means is if you have a Roth and you over contribute to that account and go above and beyond the limit. So if you're right now, as the rules state, if you're under the age of 50, each person can contribute $6,000 per year to a Roth IRA. If you're over the age of 50, you can contribute up to a max of $7,000 per year per person in a Roth IRA. Of course, as long as you qualify to contribute to a Roth in the first place, right? Let's say you put in $10,000 instead of $6,000. Well, in that example, you have $4,000 too much in that account, right? So $4,000 will become subject to a penalty. And what penalty is that? It's the excess contribution penalty, and that is 6%. So your tax on that will be $4,000 times 6%. And you might even be hit with an early withdrawal penalty. So watch out for that. If you've done that, the good news is you can avoid it, okay? You can take corrective action. So if you realize that you've contributed too much, what you can do is, as long as you take that money out before the end of the year, that extra $4,000 in this example, then you'll be fine. So just pull that money back out of your account, you should be okay. But if you leave it in there, if you leave those contributions in there and let them go, well, until you take that money out, you can be penalized each year going forward. So it's a real pain in the you-know-what. So really watch out for that. All right, YouTube family, that is all the information I have for you in today's video. If you like the information, please make sure to drop a like before you leave. Comment down below. Let me know what penalties you've heard of, or if you have any questions related to Roth IRA penalties. I will be doing a separate video on the taxation of Roth IRAs because there are times when tax applies. So I'm going to be doing a follow-up video on that topic in the near future. And if you're new to the channel, make sure to subscribe, because every single week here on Money and Life TV, our goal and mission is to help you become fiscally fit. And we do that by teaching finances, investing, taxes, and more on a regular basis. Hit the red subscribe button down below and that bell notification icon to let you be notified whenever I release new content on the channel. I usually release a new video about once per week. It was so good to see all of you again. Thank you so much for spending time with me here on YouTube. It means a lot, guys. It means more than you know. I love doing this. And I hope you have a great week. Live life uncaged, and I'll see you in the next one, guys. Peace.